Let's talk about the risk-free lie. It's one of the biggest, most persistent myths in all of investing.
And there it is, the uncomfortable truth. Every single financial choice you make, every one, has risk baked into it. So the real question isn't how do I avoid risk? It's which risks am I choosing to take?
And this is where things get really interesting, because there are two big types of risk. You've got market risk. That's the one everyone's afraid of, right? The big, scary stock market crash you see on the news. But then there's this other one, the silent killer. It's called purchasing power risk. That's just a fancy way of saying your money slowly becomes worthless over time because of inflation. It's what happens when you think you're playing it safe.
And here's the proof. Just look at this data. We're talking about U.S. Treasury bills, the thing everyone calls the safest investment on the planet. Over a huge 56-year stretch, they gave you about a 4.8% return. Sounds okay, right? Well, inflation during that same time was 4.1%, so you barely beat it. And that's before taxes. After you pay those, you're actually losing money. Think about that. Playing it safe was a guaranteed way to get points.
So what does that mean? If trying to avoid all risk just guarantees you lose in a different, quieter way, then maybe we've been asking the wrong question this whole time. Exactly. The goal isn't to find some magical risk-free investment that doesn't exist. The real goal is to choose the right amount of risk and the right kind of risk specifically for you.
Okay, so how do you do that? It really comes down to just two things that make up your personal financial blueprint. First is your risk tolerance, and that's just a gut check. How do you feel when the market goes crazy? Do you freak out and sell, or can you handle the ride? And second, your time horizon. Super simple. How long until you actually need this money? Is it for next year, or is it for 30 years from now? Those two answers change absolutely everything.
And these aren't just buzzwords. Think of them as the guardrails that keep you from driving off a cliff during market chaos. Because let's be honest, the biggest threat to your portfolio is usually you, your own emotions. Understanding these two inputs is what stops you from making those bad emotional decisions. It really is the key to building long-term wealth. And to master this, subscribe to Money Mindset.
All right, your personal blueprint. Let's see what this actually looks like when you put those two pieces together.
Okay, so this chart right here shows you just how different the right answer can be. It is not one size fits all. Based on your risk tolerance and your time horizon, your recommended portfolio can change dramatically.
So let's just look at the two extremes here. Imagine someone with a low risk tolerance who needs their money soon, like in a couple of years. Their portfolio is going to be about 90% in super safe stuff like cash and bonds. Now picture someone else, an aggressive investor who doesn't need the money for 30 years. What's their plan? The complete opposite. They're advised to be 90% in things like stocks and real estate. See? It's the same market, but two totally different strategies, and both are right for that person.
Okay, so you've got the blueprint. Now how do you actually build this thing? Well, you need the right tools for the job. And for a lot of us, one of the best tools out there is something called an exchange-traded fund, or ETF. The easiest way to think about it is like a shopping basket. Instead of buying one apple or one orange, you buy the whole basket. And inside that basket are hundreds, maybe thousands of different stocks or bonds. But you can buy and sell that entire basket in one go, just like a single stock. It's super simple.
So why are they so great? Well, for one, you get instant diversification. Your risk is spread out immediately. They're also really, really cheap, way cheaper than a lot of old-school mutual funds. Plus, they make it super easy to invest in pretty much any market around the world. And you can trade them all day long, which is a nice bonus.
All right, let's pull all of this together now for the most important part, building a sustainable strategy.
This right here is the big aha moment. The best portfolio isn't the one that gets the absolute highest returns on paper. No, it's the one you can actually stick with when things get rough. Because if you chase those crazy high returns, you're probably taking on way more risk than you can handle. And what happens when the market drops? You panic, you sell at the worst possible time, and that perfect portfolio, well, it just blew up in your face.
It all boils down to this. Expected returns only matter if your risk level matches both your comfort and your financial reality. Your strategy has to be built to survive you and your emotions. It has to be something you can actually live with through good times and bad. And this chart just shows you why sticking with it is everything. Look at the returns for just 1 year. They're completely unpredictable all over the map. But now look what happens when you stretch that timeline out to 20 years or 30 years. All that crazy short-term noise just fades away. And what you're left with is this steady upward trend. Time is the magic ingredient that reduces risk, but it only works if you stay invested.
So in the end, it's not about avoiding risk. It's about deciding what you want. The real question is, what kind of risk are you willing to accept to build the future you want?